Good afternoon and welcome to the Chicago Council on Global Affairs. It's great to see everybody here at lunchtime. What a tremendous opportunity we have today. I'm Leslie Vinjamori. I've met many of you over my last, I arrived on July 1st. To succeed Ivo Daalder, Ambassador Daalder, as the president and CEO of the Chicago Council on Global Affairs after 20 years based in London. It has been a phenomenal several months, and the very best part has been meeting most of you around who are sitting around these tables. I hope for those of you who I haven't yet met that we will have time to have coffee, have a drink. Drinks are especially good at this point in our world history, and I seriously appreciate them, but I hope I get to spend more time with you. I could not be more honored and thrilled on behalf of the trustees of the Chicago Council on Global Affairs. Many of you are here in the room. And my colleagues and our fellows and non-resident fellows to be able to very briefly introduce today's conversation, which is written by one of America's greats who's joining us today, Lloyd Blankfein, to talk about his book, Streetwise, Getting to and Through Goldman Sachs. We know there are a lot of people that would love to get to. Of those of them who get there, I wouldn't know. That hasn't been my journey, but I have no doubt that they would really love to be able to get through. Boy, would they love to get all the way through to being chairman and CEO, and now in the next phase, senior chairman. So what a phenomenal career and an honor to be able to host a conversation which will take place between our former trustee, Chris Keogh, who is Global Co-Head of Institutional Client Business and Head of the Chicago office of Goldman Sachs. We are going to give you a few minutes to eat after I've finished, but Chris Keogh used to be a trustee of the Chicago Council. He was my first coffee conversation when I arrived in Chicago on a Sunday morning to interview for this role, and so I am forever indebted to Chris, who is a friend of another Goldman friend, in New York and came highly recommended. I also wanted to mention Jerry Keefe from Goldman Sachs, who is one of our newest members of the trustee, new trustee here somewhere. Jerry, it is wonderful to have you on board in your individual capacity, but not really because you're with Goldman. And we also have as our distinguished non-resident fellow on the global economy, Lord Jim O'Neill, who spent many years at Goldman Sachs. Can't be with us here today, but was sort of messaging with Lloyd in the green room, is mentioned in the book, was the founder of the acronym BRICS, and has already been a phenomenally engaged fellow in his writings, in his webinars, speaking for the council, will be visiting us before long. So the relationship, as you know, the Chicago Council on Global Affairs is fully independent. It doesn't take an institutional position. It certainly doesn't follow in any direct fashion, and I mean this seriously, the wishes of those who support us, but we value in a way that cannot be expressed, certainly not by me in just a minute, the support over many years. And I mean that not just financially, but intellectually, by people turning up and by people bringing us their people, because that's really what makes Chicago and the middle of the country special, and the Chicago Council be able to host conversations like we're going to have today. So at a time when we need leaders, at a time when we need reflection, at a time when we need people to cut right through to what matters and say it like it is, no better place and no better conversation than the one that we are going to have very soon. We are on the record. We are not live streaming, but we are capturing the stream, and so it will be shared out after this event has concluded. So if you speak, you will be recorded. So it's a fabulous opportunity, and certainly for the author and Chris, who will be in conversation with him. Please enjoy your food, and we'll give you a few minutes before we begin. Thanks so much for joining us.
Well, thank you for this incredible opportunity. Lloyd, welcome to Chicago. We're all very grateful to have you. Before we get started, special thanks to Leslie for her and her team hosting us. It's a terrific time to have you in town and to talk about a great many things. The book is incredible. Everyone should know it. It is debuted at #4 on the New York Times bestseller list. And so with your help today, we'll get that up to 2 or 1. And so buy early, buy often, kind of like voting in Chicago. And so anyway.
Think of all your friends and family.
Right. No, exactly.
Yes.
The holidays are just around the corner. Load up right now. So Lloyd Blankfein, chairman and CEO of our firm from 2006 to 2018. Prior to his time at Goldman, a tax lawyer, which in the book he tells you he hated. But a proud graduate of Harvard Law School, and before that, Harvard undergrad. The book is wonderful, at least in my opinion, because first and foremost, it stays true to Lloyd's voice. And so, for those of us who know him, it's like he's reading it to you. And terrific anecdotes that
scares even me.
Yeah, well, I understand. I look forward to the audiobook. I assume that you'll be reading it.
No, it's already done. It's in the can. It's
okay,
ready.
Fantastic. Well,
by the way, you can fall asleep every night listening to it.
Well, I do need help.
Actually, you did fall asleep listening to me. You used to be an Asian. I used to call you.
That's correct. You always used to hear me snoring.
Yes.
Usually when I was trying to get to the important parts. Lloyd, let's get started with the first and most obvious question. You stepped down as chairman and CEO of 2018, but did not write this memoir until now. Talk to us about the timing and your decision-making process on deciding to do this book.
Well, actually, I started it something like 4 years ago, and I was going along just fine because the beginning of it was the beginning of it was flowed easily because anybody who could contradict me was dead in the early parts, and then when I got to the part of things where people were still alive, it got bogged down a little bit.
Right.
So now I started it. It was a little bit bored, a little bit COVID-y outside, and I started, but what I just said is actually kind of true. I wrote a lot of it, and then I put it down, and then I picked it up, and part of it was. It's like, you get out of these jobs and, you pick up your grandkids' plastic telephone, you bark some instruction and there's nobody on the other side. And so, you want to comment, I was tweeting a lot, and I'm that rare person who tweeted a lot and argued with people and didn't get canceled. And being in risk management, I thought it'd be a good time to stop that.
Well, you canceled yourself at the exact right time.
I did.
I mean, much to our dismay, because the banter back and forth was usually very entertaining to those of us who have worked with you at the firm.
Yeah, but the problem was I started to mix it up with Elizabeth Warren and Bernie Sanders, and I realized...
Well, they love you.
Yeah, I realized that, why am I fighting with people with subpoena power? And so
So the lawyer in you and the risk manager in you.
In the risk management, I went through the whole financial crisis, and I quit. Most of the people who had my kind of job usually get carried out of their positions, and I always thought one of the if you're gonna be a risk manager, you have to stop doing things when you still like it. Because when it goes bad, when these things go bad, you can't leave, and so you have to leave when things are going well. When you really don't want to leave, but you have to have the discipline to do that.
It's interesting though. This book is arriving at the perfect time. So the book, for those of you who haven't read it, has wonderful stories and anecdotes of his childhood, how he got to Harvard, and we might explore these today. The majority of the book really delves deep into the credit crisis, Lloyd's leadership style, the things that he wrestled with. And I think it's that part of the book that feels most on time and resonant right now.
Yeah, like you say,
we're at the tail end.
The credit card. You mean that credit card as opposed to this credit
crisis,
yes.
Yeah. So this credit crisis, which is not a crisis yet, but there's cracks in the credit cycle. Love your thoughts on that. And then you also are an astute reader and student of history. You care deeply about geopolitics. we live in interesting times. So maybe comment on that.
Well, that's a lot of stuff. Where do you want to?
Well, I mean, we have 45 minutes before I
know,
even have
but
to open it up for
why
questions.
don't you break it down into chapters?
Okay. Well, I haven't written a book yet, but yes, since you're the client here, let's break it into the first chapter. Talk to me about your thoughts around where we are in the credit cycle, how serious it is, and maybe also talk about your thinking around mark to market.
Well, I'm tempted to say we're closer to the end of the cycle than we are to the beginning. Every day we get closer to the end. I think one of the problems, just stage setting, we haven't had and this applies to a lot of assets. We haven't had a reckoning in a long time. Generally, you go through something like the big financial crisis, and everybody gets kind of scared to death, and everybody gets very, very disciplined for a while, and eventually that discipline erodes with the passage of time. Memories fade, new people come in, new risks get taken, and that's why there's generally a cycle for things. Now, generally during my tenure, we kind of had the crisis of the century like every 4 or 5 years, whether it was the dot-com bubble, long-term capital, Russia default. We just had them periodically, and it's a little bit like in in the movie The Godfather,
Right.
where they say, it's good to have these mob wars because you get rid of all those grudges that build up over 10 years. And I'd say it's good to have a reckoning every once in a while because it gets rid of all the indiscipline that's on balance sheet that doesn't get reflected very well. And so there's undoubtedly, not having had really a big set of problems that affected the market since 08, 09 period, you just know that there's been a lot of stuff that built up. And what does that mean on balance sheet? It means things that nobody's committed. I'm not suggesting that there's fraud being committed. I'm certainly not. But there's, indiscipline and marks, assets that don't trade with any liquidity, that get, that went on people's balance sheets with optimism, and that optimism hasn't had to be challenged for a very long time, and no one has had to force sell into a market that didn't necessarily want the stuff. And so that's the general context. So I think it's perfectly appropriate to be looking at places now, or to just use another metaphor, there's a lot of kindling on the floor of the forest. And at some point, and it's almost inevitable, a spark will happen. Now, if the kindling wasn't there and there was a spark, nothing would happen. Yeah. And so everyone say, what's the precipitating thing? Well, it'll be something that at a different time wouldn't have caused a fire, but it will because there's just been a lot of buildup of stuff. Now, people are unnerved a little bit about the credit, because, and specifically because we're talking about some cases, private credit is in the news. Those things don't get really marked. I was reading somebody else's, the report. They get marked maybe once a quarter. I read that. I didn't know that because at Goldman we marked every day. Yep. We marked all the time, which was an important discipline. And what we also did is we forced people to sell things.
Well, I think that comes through the book multiple times, that there was a rigorous mark-to-market culture that you grew up in and really double-clicked on as we went into the crisis, and we were ahead of it because of that discipline. And there's wonderful anecdotes about, we always allow risk management to have an equal seat at the table with whoever is trading the position or has the position on the books. And if they don't agree with the mark-to-market, and this is what was fascinating, you said, that's great, go sell it. And
sometimes we just said, again, there's, people now characterize, which I think is the funniest thing in the world, semi-liquid positions, which to me means...
It's great for retail.
No, semi-liquid positions means it's liquid the half the time you don't want to sell it, and illiquid the half the time you do want to sell it. So that's hence semi-liquid. But that's a phenomenon. So that kind of stuff is built. And now I'm not talking about any specific thing. And by the way, to get to the punchline, I don't think this is that specific thing is a particular systemic problem, because it's not that, I think it's not that leveraged. Now, I also thought at the beginning of the big financial crisis that mortgages weren't that leveraged either, so you just don't know. The point is, we just don't know. but it's being challenged now. You can't say it's not in the atmosphere, and people are looking at that pretty hard. What it doesn't feel like to me is it doesn't feel like a banking crisis, because it's not. There's no real. Some of these funds are leveraged, but they're not very leveraged at the fund level. Right. And I think the market could absorb that. And there's, the loan to value was very, and I also take note that some of the, and again, I have no inside information, but I observed, I saw that JP Morgan took down the value of the collateral. Right. Some people interpreted that as JP Morgan was marking down its assets, but no, it's marking down the assets it's holding as collateral from some of these funds. So in effect, it's raising the margin requirement incrementally. And so I'm not 60, I don't know that will be. And usually if it's something that we're all worried about, it's not going to be from that quarter.
Right.
Probably it'll be somebody, it'll be some technology hack or somebody's fat finger that wipes out stuff where nobody knows who's solvent and who isn't, that causes, but it'll be, it feels overdue for, and I say it's overdue for a reckoning.
Yeah.
And the
and
reckoning
it can be healthy.
To
use your kindling analogy.
It's a
Once
funny
the
thing.
forest burns down, then
The
new
mere
things grow.
passage of time in a cycle, in an investing cycle, creates higher and higher levels of risk, because the more stuff that accumulates, the brighter the flames will be if it does catch. It's kind of a funny way to say it, but and kind of without necessarily articulating it, I think a lot of participants in the market, which is why anytime somebody steps on a twig, everybody pops up into the air, because everybody's very nervous.
Right. Okay.
By the way, the general context of the market and the economy on a macro basis is actually quite positive.
Right.
And you can lose, if you just watch TV all the time, you could lose sight of that.
Yeah. And you could also argue that a steeper yield curve, there's a cost of capital now that makes sense as well.
Right. Again, part of the buildup of the kindling was for a long time, like when these things were put on, the cost of capital was kind of zero.
Right.
How do you allocate a commodity that has, the price is zero? You get very, you get very indisciplined.
Right. You started your career in J. Aron, our commodities business. It's now fascinating to me. Again, you're a student of history. You know a lot about the commodity markets, amongst other things. When you look at what's happening in the energy markets, industrial metals, rare earth metals, what do you think?
Well, I wish I was longer. That's what I think. Look, the whole world right now is focused on the price of oil. The Gulf, what's going on in the Gulf, and specifically the Straits, and the price of oil, and that's really, if it weren't for that, and you could see every time it looks like the slightest ray of sunshine coming through, like they let a boat through, or something is going on, you could see what happens. I watch it closer than most people do here, but the equity market just pops and go back. Just taking a step back, the economy is doing very well now. Before all the hate mail comes in, it's doing well for a lot of people. The K shape that people talk about, the rich getting richer, the poor just sort of staying the same, and so the gap between rich and poor is widening, and so that's really why society is so polarized. And there's a simple reason for that, which is unfortunate in a way, is that the asset prices are bulging. And so if you have assets, you're doing really, really well. And if you don't have assets, you're not participating.
And you've also discussed in other interviews, and I think it's very salient for this cultural moment in time in the country, this K shape that you're talking about. It does have some of its seeds in the 08-09 era. Do you want to talk about?
Well, I would say the general, polarization has seeds in that area, and the kind of the bitterness in the politics certainly has seeds in that.
Elaborate.
Well, we all, looking around the room, everybody in this room lived through that era.
Right.
And obviously, the people that you would want to have been punished seems to have merged a lot better than the people you would want to have helped.
Yep.
And that happened a lot because in addition to being, it wasn't a normal recession, it was a normal recession with a big banking crisis.
Yeah.
Now, some of the banks went under and everyone lost and people didn't, but at the end of the day, the instrumentality for getting out of a recession is the banking system. Mm-hmm. And the government doesn't lend money to people. The central bank doesn't lend money to people. Banks lend money to people.
Right.
And if the banks are so distressed that if they get more money, they just husband it and use it to build reserves, and they don't go out and lend more or participate more in the economy, you get a very, very elongated recession, which is in fact what happened.
Yeah.
And so the government, trying to sort out the banking system, I won't say inadvertently, but with awareness and regret, did things that were favorable to the people who participated in the banking industry, and didn't offer the same help to secretaries who, put a down payment and bought an extra house and lost that house, or maybe even their only house. And so that's a big problem, and contributed to, wasn't the only data point, but it's certainly a data point that created a schism between the haves and the have-nots and widened that gulf. So that's a source of, and I think would we have had the right wing of the Republican Party or the left wing of the Democratic Party without that kind of thing? Perhaps, but certainly that's a contribution.
Yeah, agreed. There's a heartbreaking story at the beginning of the book about how you went to visit your father when he worked in the post office, and you saw one of the first mail sorting machines, and it dawned on you that this machine was about to go into use, and that your father and so many other people that were your father's friends would see their life's work change. Can you elaborate on that? And then
I'll just say the context. I mean, my dad was I grew up in public housing. My dad was a mail sorter in the post office. I never saw where he worked. I had a vision of what it must be like sorting mail in the post office. My dad knew the name of every village in Connecticut. That was that's what he did. This is like even pre-zip code. And when he retired, we all snuck in so we could see the people he worked with, and he was sitting at a long bench with a lot of people sorting mail, and behind him was this big machine. And I said, "What's that?" And he said, "Oh, that's the electric mail sorter, a big machine, and it'll sort and do everything, frankly, do everything better and without making mistakes." And they don't turn it on. It's not the story. The conclusion wasn't what you said. My point was, what a waste, because they could have put that machine on, but being the post office and the government, they don't fire people. And they just, they waited for attrition. They waited for my dad to retire or die. And before they started turning on those machines. And I'm thinking, God, I'm going to make sure I'm not at a job where where I'm moving bricks from one side to the other. There was something so inconsequential that didn't have to be done. They could have just turned that machine on. My point of that story is not that I was sad that that future generations of mail sorters were displaced by a machine. I was sad that what a waste of my dad, who was a bright guy, came up through the war, didn't have an opportunity, had kids, and so never went to college, and so I was sad for the waste of it all. I'm very pro technology. And I know that
that's where I was going to get to, because I think there's a lot of legacies for your stewardship and leadership of the firm, certainly through difficult times in 08, 09 and what followed, certainly the incredible collision between banking and government. We'll touch on that in a minute. But I also remember an article that where you were on the cover of Fortune, where you said that the thing that kind of kept you up at night the most was disintermediated technology that would come out of nowhere. And I always thought that you were always kind of on the front line with the rest of the leadership on trying to figure out how to use technology to change market structure and everything else.
Our industry really drives it. I mean, just to take again, if people move a half a block closer to the computers of the New York Stock Exchange, because it's, sometimes when you trade these things, latency, it's a winner take all. And if you get there, millisecond faster than someone else, you win, the other guy loses. There's a lot of drama associated with technology and, figuring out how to do this. But in the current debate, there's of course a lot concern about the displacement of people by AI. And, I'm not going to minimize it. It's a real issue. People have to be concerned about it. Maybe there's job training. Maybe there's other things that have to do. I don't know that people who do software programming are going to be happy becoming massage therapists
Right.
or stuff like that. There'll obviously be a lot of dislocation that has to be done. But overall, and again, on a macro basis, and life doesn't operate up here, it operates at the street level. But on a big level, I cannot feel sad about about technology that's going to make everybody much more efficient.
Right.
And much more leverage to accomplish things and make things take less time and have a better outcome. So I think all the Luddites out there that would resist and say, no, you can't use these stuff because people will find jobs. Again, it won't be without dislocation, but at the beginning of the 20th century, I think half the workforce in the United States was in agriculture.
Yep.
And now it's single-digit percent.
Yep.
Somehow everybody found a place, and everyone found jobs, and the elevation
And
of
the
Detroit.
same thing from industrialization to information services economy.
Now we're sitting here, in this nice auditorium on these nice chairs, and it's not going to affect us because. So we don't have to worry as much. I understand on the ground and for specific people and specific categories, it's a much bigger deal and much more disruptive, and frankly, much more eclipsing of people's sense of where their future is. So I don't want to minimize that. But again, from a societal point of view, I'm not against that kind of progress. You can't be against that kind of progress. And by the way, it wouldn't help if any of us were against it.
Right.
You don't unlearn stuff once you have it. You could wish that you could say to yourself that the benefits of nuclear power are outweighed by the problems that we've gotten from nuclear power, but it doesn't matter. It exists in the world, and it's not going to unexist.
Right. Do you think it has the potential to exacerbate the K-shape that you discussed? Those who have assets are likely to see a massive appreciation in assets.
I mean, that's a leading cause of it. Technology always does that in a technological revolution.
Yeah.
Just like in the post-Civil War era and the rise of the robber barons, that you tend to get a very, very large concentration of wealth by the people. The means of production become much more important than the labor, and they get richer, and that gets multiplied out. And we see that happening again. It's analogous, just on steroids relative to the 19th century.
Right. When you go back and you think about your leadership through the crisis, the book is peppered. I was so thrilled that you kept them or someone found them for you. But there are printouts of the voicemails that you used to leave the 40,000 odd employees of the firm, and they were very, very reassuring. But they were also very crisp, very clear on where we are, where we're going, and never saying anything other than we live in uncertain times. And if we do these things, we're going to get through this together. How did you when you look back, how did you find your voice, and what were some of the prevailing things going through your head?
Look, I was scared. I can't speak what leadership means to other people, how people perform, but I could tell you there's a lot of energy. There's a sense of I was as scared as anybody. It was scary, and it wasn't scary because this is going to happen. It was scary because things could happen.
Right.
And in a crisis, people always say, "Oh, this is a worse crisis than the past." Well, the past is resolved.
Right.
It's not scary anymore, and so it's on the shelf. But something you're living through is always like that, and you didn't know where things would go. I was always communicating with the firm, and this is a larger matter. Our firm was always a partnership.
Yep.
And I think one of the big accomplishments of the last 25 years, it's been 25 or 26 years since we were a partnership, but it's still run like a partnership.
Yep.
Hank, son of Chicago, ran it that way. I did. My successor does. And there's real meaning to that. Because in a corporate hierarchy, lightning bolts come from the fingertips of the CEO. This is it. There's a pecking order. There's actually law that says you have to sign this form. This one doesn't have to sign. You're responsible for this. You're the one that gets hauled in to testify if anything goes wrong, and blah, blah, blah. In a partnership, it's certainly at least the senior level of workers are not just subordinates on an organizational chart. They're your co-owners. Yeah. And co-ownership involves a lot of things. With the co-owners, people feel that their success and their wealth and their health of their family depends on the performance, not just of their job, but of the firm as a whole.
Yeah.
They expect to have influence on the whole firm because they're owners like you are.
Yeah.
And they expect to have information and be informed. And that expectation is there. They expect not only to be consulted, but to influence outcomes.
Yeah.
And, and if you're a senior partner as opposed to a CEO, and I was half my tenure at the firm in a partnership and half the tenure in a public company.
Yeah.
In a CEO, you make decisions and you put out a memo. In a partnership, you socialize stuff. You say, this is what I'd like to do. You have conversations with people who might object. And when the objections get louder, you may put it aside for a while. And a few times you may put it aside forever if there's that kind of, and in return for that, and eventually the buck stops with you. So sometimes you do things that people don't like, and then you explain why you did things you don't like. Because again, in a partnership and you're dealing with your co-owners, it's a different head that you bring to it and a different outcome. And the people who run the place can maintain that only by operating that way.
Yep.
And in return for that, you get a different kind of ownership, a different kind of firm. You get a firm of co-owners and all that implies, real commitment in that. And so that was a long predicate for saying that part of during the financial crisis, at the end, what I needed in the financial crisis, I didn't need everybody to stop what they were doing and stare at the CNBC screen gawking and watching our little stock prices, a ticker in the corner of the thing, with their jaws open, staring at the screen. Everybody wanted to help, but there was nothing really to do. I needed 2% of the firm to be working on Goldman Sachs's issues, and I needed the other 98% to just do their jobs better than they ever did it before. So in other words, if you want to come out of this crisis with a better reputation, take care of your clients, do your job, stop looking at the screen all the time. And I'll tell you what, in return for that, I will send a voicemail and I'll let you know what's going on. And so I did every day. And I went through my normals so that people wouldn't get hysterical, like that, as if I were staring at the screen. I went to Beijing and I went to this place. I kept my schedule, and I'd be running, and my knees could knock together, and I could get, I can swallow my Adam's apple just as easily on a plane as I could sitting at the office. So we did all that stuff, but every day I sent out a voicemail and say, look, I just landed in Paris. We do this. I saw these accounts, blah, 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 normal. And let me just tell you where we are in this cycle of working through these issues.
But you had a natural mentality that's noted famously that allowed you to keep things in perspective. You walked into the Federal Reserve and a colleague was complaining or expressing an enormous amount of fear for what was going to unfold inside the Fed that day. And you famously said, "This is we're not on transport boats landing on Normandy."
Get it. But look, it was like the ninth. It had to be at least the sixth weekend in a row. You got called on Friday to go into the Fed, because we're dealing with Fannie Mae, we're dealing with the money market situation, we're dealing with Lehman, we're dealing with one or another of those issues that were coming down the pike. And so you go in, and so I don't know, the fifth one, everyone's getting through. And by the way, driving into the Fed through myself, protesters, let's just say, with big signs with my name and picture, and other people as well, not just me, on it going down, and people saying and people basically, oh, woe is me, kind of stuff, and you were working it out. And I said, look, you're getting out of a Mercedes in the basement of the New York Fed. You're not getting out of a Higgins boat on Omaha Beach. Get a grip. But having said that, in a way, if you have a sense of duty and responsibility, you lose the opportunity and the desire to be scared yourself. Because it's like imagine that your kids were threatened. You're not sitting there with a calculus of the risk and rewards to yourself versus your kid and where you're going to come out. You have your sense of responsibility as a father or as a boss or something like that. It was, in a way, it was kind of, I hadn't thought about it just now. It was it's a funny thing to call it a blessing, so I won't say that. I'll say that it was an advantage to be consumed with the need to take care of other people. And it wasn't, it wasn't even self-sacrificing. It never got to that age. I had to take care. I had that was my responsibility. And so if it weren't, if I were a subordinate sitting in the back seat of the car, I might have been the one whining.
Yeah.
But since it was the responsible one, I try to get everybody, stop whining, let's focus. There are a lot of people worse off than we are. And you're not, and these aren't bullets being shot at you.
Right.
There's, this is about money, which, by the way, to some people is more important.
Okay, so you talk about how the partnership that you lived in for the first half before being a public company helped to inform how to run the firm when in crisis. How did you develop the skill, or what was your growth around the transition of all of us realizing that the company is now very much a public company, and you're being heavily scrutinized, whether it's in front of Congress or in the media, because that was all new for all of us. And so it must have been new for you too. How did you approach that, and how did you grow into being able to handle that?
Well, I don't think, I wasn't always the polished person you see before you today. I don't think I was picked or honed particularly for a kind of public life. And, it was, and it wasn't a requirement of the job. In fact, we had a whole publicity department at Goldman whose only job was to keep us out of the newspaper,
Just to say no.
Put our clients, we're a wholesale firm.
Yeah.
Go get a mortgage or open up a bank account. Go to your branch office of Goldman Sachs, write a check against Goldman, see what happens. That wasn't our business, but that was a big mistake, and a big mistake that I made too, because we were too big, too influential, too important in a way.
Yeah.
Our people, our alumni, were too out and about the world, and our name was too out there to be anonymous.
Yep.
And that hurt us a lot, because if we created a vacuum around ourselves of awareness of what we did, there were a lot of people eager to fill that in.
Right.
I'm not saying, we all took our licks during the mortgage crisis. We had our role in it. We bought mortgages from other people, and which thereby gave them the money to go out and originate more bad mortgages that they shouldn't have. But we were hardly ground zero for the mortgage crisis. We didn't do mortgages other than secondaries, which was not nothing, but it was hardly ground zero for us. Yet we got, a lot of treatment because everybody had their friends at Chase Manhattan, as the slogan used to go, but not necessarily at Goldman, because the other word for consumers and retail, which we didn't touch in our business, are citizens and taxpayers.
Right.
And so the official sector came down on us most hard. The other reason why they came down on us really hard is because we didn't lose money.
Right.
And it was pointless to go after Lehman or Bear Stearns or even the bigger names that are still, vibrant, important firms today, all lost tens of billions of dollars and really were an extremist. And we managed our risks largely because we marked to market and hedged ourselves and knew earlier than most that something's going on here and we should get closer. We should
get closer to home.
Go closer to home and narrow our risk taking, not because we knew what was happening, but really because we knew a lot was happening and we didn't know where it was going to go.
That becomes a framework for a lot of things in your life, it seems like. And again, I think very apropos of the time that we're living through, which is you always say, don't tell me what you're so certain of. It's the uncertainties that you have to be prepared for. But you've been very, very acute to listen to whatever signal comes through. There's a very interesting anecdote in the book that you're sitting in the movies with your wife and you're staring at your BlackBerry and not paying any attention to the movie, which your wife must be a saint for so many reasons.
Does anybody pay attention to movies?
Other than your wife, who knows?
No, yeah.
But there was data that was coming through on your BlackBerry that made it clear that some funds that we had were behaving in a way. But part of getting closer to home is being able to see the signal and know that it's uncertain, but the signal is there.
They're two very different things that one does in the risk business. Everybody's focused on the first, which I'm about to say, which is, let's try to get the market right. Let's figure out where things are going and get there. Let's give good advice, so that people, and if the advice is good enough, people, still come to you as they have for us for about 160 years. Right. But you try to get that right, and nobody knows everything. You do the best you can. there's another activity called risk management,
Right.
where you are not concerned with what you think is going to happen. You're worried about anything that can happen. And it's a whole different exercise. And, sitting in the movie theater, doing what I always did at that time of night, whether I was in the movie theater, at a dinner party, or, pretending to have a conversation with somebody, I was looking at the P&Ls as they were coming in. It's like watching the election returns on that Tuesday night. And I'm looking at something, and because it was a movie, I had a lot of time.
Right.
And so I'm actually going deeper and deeper, and I didn't pay as much attention to the asset management P&L, because it's almost like a separate firm.
Right.
People invest in this fund, and it has portfolio managers, and I don't manage it. And in fact, we don't even, everything reported to me because I was head of the firm, but it has a lot of latitude, its own risk, whole infrastructure for risk management, GSAM, Goldman Sachs Asset Management. But I was looking at the funds, and there was kind of a relative value, fund, where you buy one thing and you sell it again, and you lever it up, and you make a smidgen, and you multiply it by 20, and you have 20 smidgens.
Right.
So, and you do that, and something that, like, on a busy day would move 6 basis points, 6/100%, and it moved 8%.
Right.
And I said, whoa, something is happening here.
Yep.
So that was the end of the movie for me, and went back, and that was kind of the start of it. And then after that, we kind of went into risk management mode, as opposed to where's it going. We had people in the firm who thought, my God, just like Ben Bernanke in the official sector, the mortgage thing is relatively finite, contained. Let's get in there now and buy. And other people say, no, it's going to keep going. It didn't matter. We put out the word, let's, in a very Goldman expression, let's get closer to home. And we go around and talk about contingency planning. And now we're not in the forecasting business. We're in the contingency planning business. And,
Like you very famously said, if you had known that it was going to continue, then we would have shorted.
Oh, yeah.
Right.
Somebody
we just
asked
got
me,
flat.
if you knew where things are going, would you have done anything different? And I said, yeah, I would have gone short everything.
Right.
What kind of stupid question that is. But, I remember going around the table, and a very senior person said, which is the worst thing to say, well, I think such and, basically, what do you think can happen? What do you think can happen? He said, what are you doing about this? What are you doing about that? And somebody instead said, well, I think the market's going to go blippity blip. I think it's overdone. And I said, no, I don't care what you think.
Right.
Tell me what you're going to do if such and such happens. He goes, well, if you don't care what I think, tell me what you think. I said, I don't care what I think.
Right.
I just want to know if these what you think is a low probability. And when you get in that stage, all sorts of, 10 standard deviation events seem to happen every day.
And nothing can correlate to
Yeah,
it.
nothing
to one.
correlates. All that goes out the window.
Right.
And so I just want to know, and if you get that if you realize that now you are in the contingency planning business, what are you going to do with this? What are you going to do with that? What are you going to do? What are you going to do? What are you going to do? And if you're good at that, when one of those things happen, you're off the mark so quickly, people think you anticipated the starter pistol. They don't think you heard it. You got off too quickly. You must have either forecasted it or, or jumped the gun.
Yeah.
And I think that's a cultural thing. I think we get through, we jump the gun, we work through those possibilities. And by the way,
Because we listen to the gun.
and you don't get it, and you don't get it all, and something bites you, and and if you do that, go into that mode too many times, you'll miss other opportunities that people who aren't so risk management oriented get. You don't always get rewarded for your great behavior. You don't always get punished for your bad, negligent behavior. But on the whole, given enough time, it's better to be good than bad at this stuff. And that was a lot of that. That was a lot of that crisis. Today, I would be making my list and checking it twice. I'd be, marking everything. I'd be testing the market on some stuff. I'd make people sell.
You make people sell to say
sell something that they didn't want to sell, and just to see, is there a market for this or that? Certainly on, and anything on assets. Look, we're coming out of a period where it's been the best equity. Even now, we're not that far from the highs in the equity market. Super high in the equity market, the best financing market you could have had.
Yep.
But think of all the inventory that's building on the balance sheets of alternative managers who are very incented to sell because they're trying to raise money. It's hard to raise money unless you've returned money.
Correct.
And yet they haven't sold a lot of their inventory of prior investments in a market that we've just come through with high equity prices and easy financing terms. If you're into it, so that goes to the build-up question, and I'd be really kind of checking that stuff.
Right.
Really, really high.
And I know the first thing you do in the morning is check the markets, and ever the trader, you haven't strayed from that. What's
Every morning,
every
minute.
morning, every minute? Well, thank God we made you keep your phone in the green room.
I would say an occupational hazard
Right.
of starting out in commodities and on foreign exchange.
Yeah. And what is
I'm a very light sleeper, to say the least.
what are you willing to share with this crowd about what you're invested in now? What's your framework? What's your setup?
Well, I'm going with the new economy. I tend to, I think this has been a good opportunity to get into the big companies that are down and trading at market multiples now.
Right. The
And,
super scalers.
Yeah, the super scalers who are still growing and are going to survive under any circumstance. It doesn't mean I don't do any things that are striving companies and up and comers, but those are risky.
Sized
But my base case, I had been in energy for a while, and it's also been a dividend play. It's also they trade at low multiples, and having been an oil trader at one point, I know it doesn't matter what you think or what people think is going to happen. Periodically, something comes out of left field.
And here we are.
Something comes out of left field, and so 2 years out of 10, something is going to happen. In the interim, it's not too bad to hold that stuff. Right. I still think that's the best hedge. I'm not gold could go to 20,000. It's going to get there without me, and Bitcoin is going to certainly get there without me. But I still, so I still do that stuff. I think, I tend to be, if I say I get things wrong, I tend to get things wrong on the more optimistic side, but that's a better side to get things off, because most of the time the world advances and doesn't retreat. So I'm certainly vigilant and have nervousness, as I described at the beginning, about something is overdue. But my base case is, economy's going pretty well and into a pretty good economy. We're going to lower rates, and a lot of fiscal stimulus is coming this way, and the hyperscalers are spending, and there's a lot of productivity gains. My base case is things are good, providing they don't we managed to survive the Gulf of Hormuz.
There you go.
Yes, and which is the big thing roiling the market, and that's a big obstacle right now. But my guess is it's so dangerous and so bad. Everyone in the world is incented to solve the problem, so I think it'll get solved pretty quickly.
100% agree with
and
that.
the market says that.
100%.
The forward markets in energy are not where the spot market is.
Right. Okay, I think we have time to take a handful of questions. I can't see particularly well, but we have people holding microphones. Great. Gentlemen all the way in the back. And please state your name, if you will, and your organization or affiliation with the council.
Thank you both for your time. My name's Adam Gipolo. I'm a partner over at Next Public Affairs. We're a national public affairs and strategic advisory company headquartered in Chicago. I'm also a former emerging leader with the Chicago Council on Global Affairs a few years ago. My question is about the current fiscal debt and, what steps with the U.S. government and our ballooning deficit should we be taking, and any advice you would offer the folks in the White House and the Fed to start reining in both our domestic spend, but look at ways to really crimp down on the national deficit?
Well, the way we'd like to solve the problem of the deficit and be good for the world is if we just keep growing and make it lower as a percentage, but we seem to be going in the other direction. The worst way to do it would be to inflate the currency and return dollars that don't have the purchasing power to all our creditors. And that's one of the reasons why it's so bad to be going at the Fed, because the Fed is the guardian of the value of the dollar, and people who've lent us money are looking to the Fed to protect their interests. And if those interests don't get protected, they'll our creditors will either require a much higher interest rate,
Yep.
or else stop lending to us completely. So what can, I'd say if you're in the government, you want to promote growth and earnings and increase tax revenues on, and hopefully they won't take, make the system less progressive than it is now and cut things to the point where we keep inflating the debt, rising the deficit. I'm a sort of not so antagonistic to the efforts that are being made now to cut some of the spending.
Yeah.
And I'm way over my skis in some of this stuff, and I'm not saying that everything that would happen in Doge was good or that anything that happened in Doge was good, but I like the idea behind some of this stuff.
Right.
I don't know that we need a Department of Education.
Right.
I know I want to keep spending money on education, but usually that's administered by the state. That's a fairly recent cabinet position.
Right.
And we functioned pretty well without it before. I don't actually know what they
Do.
Right. Other than distribute money and punish, and if you don't observe Title VI, we won't give you the money, or we will give you the money, and do that. And I think there's a lot of things like that. There's very little that ever was built in the federal bureaucracy that ever has been dismantled. I know there are parts of my firm which we thought from time to time was a good idea, and then it seemed like a bad idea. And that always lasted too long until we had some sort of crisis when we had to tighten our belt. I don't mind some time where we decide that somebody has to decide that federal government has to tighten its belt. So I would like to see, everyone wants to get rid of waste, fraud, and abuse, but I really do think that there's a lot of waste, and it's not a matter of just cut. I think there's whole things that we should just stop doing that we hadn't done previously, and we could stop doing now.
And by the way, you could reallocate that capital for things that we might want to do.
Always, but anyway, I would say the easiest thing to do, safest thing to do, most desirable thing to do is grow our way out of it, which is, by the way, how we have done these. And I'm not going to kick the U.S. economy because usually size is the enemy of resilience and speed and agility. And we're the biggest economy. We still grow faster than any of the other developed countries of the world.
And some of that, if you kind of go back through your career, I think of over the 35 years I've been in the business, the two things that kind of continually stick out are access to information and speed to information and ability to get into data rooms and get access to make decisions has become ubiquitous. And then the movement of capital and where it flows to its highest and best usage has become incredibly efficient, and no place more so than the U.S. Does that comport with your experience? And because I think so much of the U.S.'s resilience, we will get things wrong, as one does, or as institutions do. But the wonderful thing about the capital markets, other than you have everything from bankruptcy to capital gets reallocated very quickly to whatever the best usage is.
Look, I'm not in there, but we were pretty tight managers, and sometimes you have the wind at your back, and not only don't you think of pruning, it would be so unpopular if you did because you're doing too well, and there's no. Sometimes you need a consensus that we have to do this, and that usually happens in difficult times. Very hard to do this stuff in good times. But I think of, and I mentioned Doge before, so let me say something.
Sure.
Positive. When Elon Musk took over Twitter, I think he fired 90% of the people that worked there.
Right.
I don't know that anybody who used that service knows the difference.
Right.
And I don't think they're missing. I don't think they're missing the 90% of the people that are gone. Now, I made that 90% up, but I think it's something like that. Yeah. So I'm not sure. But I think that if somebody took a very commercial sense into that and wasn't insane and didn't sleep on his couch and bring in 14-year-old kids to run it, I think that that's a reasonable undertaking to do. But there wouldn't be a consensus to do it. And everybody would scream if their ox was getting gored and stuff like that. And it may take a crisis, and even in our firm, you didn't want to, you sort of valued those times when everybody was a little bit scared because then you could do things.
Correct.
The consensus would form very quickly that we really have to cut, right about the time we cut everybody's bonus, there was a consensus that we should get rid of some of that dead wood.
Right. Question far in the back on the right. Again, please let us know your name and your affiliation to the council.
My name is Dermot Horgan. I'm a supporter of the council. With so much, you mentioned education, and with so much emphasis on science, technology, and all of that, I see that you have a degree in history, and I'm wondering, was that 4 years wasted, or did that historical perspective help you in your career and in your view of the world?
By the way, in the interest of disclosure, my degree is in general studies because I was such a late bloomer, poor student that I was lucky I graduated.
Well,
But I did mostly do history. I'm a much better student now.
Just to double down on this, and because I thought it would help me in my career, and it clearly has not. I shaved my head. I grew a beard. I also have a degree in general studies.
Yes, good at that. See, two generals sitting up here.
Right.
And, I'm a great believer the importance of studying history, even for the markets, because as that old cliche goes, history may not repeat, but it rhymes. And I think an appreciation of history makes you understand cycles. It makes you less elated at the highs and less depressed at the lows, because we've gone through this before. And a lot of the times when I approach people, when they were going, when they were scared and this, and I said, listen, this is not the worst thing we've gotten through. Yes, it is the worst thing. I said, it's only the worst thing because you're going through it. But I will tell you, I was a sentient, old enough human being in the late 60s when there was political assassination in the country, when kids were going to Canada, when the National Guard shot kids on the campuses, when Russian tanks in '68 rolled into Czechoslovakia. I'd say the world, and by the way, it was not that many years after the Cuban Missile Crisis where U.S. forces globally were on DEFCON 2, with DEFCON 1 being nuclear war. I'd say that was a little more dangerous than what we had today, even though we're sweating what we have today. And things can get worse today because it's not resolved today. I think having that perspective, is very valuable to the psyche and to sentiment and to getting people to work through things and the challenges. I had this conversation with someone recently, my age, and I said, this is how we got to go. And I said, I was born, you can do the math, I was born in late 1954. I'm 71 years old. I don't think you could, in my life tenure, I was too young for Vietnam. I mean, really, it really was compared to my father or my who lived through the Depression and we kind of got, it's a little bit like the market gets soft because we haven't had a reckoning for a long time. We haven't really contended, I'm not saying we contended with nothing, but compared to prior generations, I think learning history, it gives you a very, very important perspective, not necessarily on specifically how to solve the problems today, but the attitude you take to resolving problems.
And do you think, to follow up to that, do you think that humanities will have a renaissance on college campuses in the age of AI? Because to my mind, the ability for someone to, first of all, read, then formulate an opinion, articulate that opinion, and then be comfortable with it being challenged.
I'll just start it. Yes, I think college is for, not people don't do this, in my opinion, is for liberal arts. That's my recommendation. I think, this Peter Thiel view that, you're wasting your time if you go to college and everybody, and I think you're just doing such a disservice to people. I think it's for your own benefit, you should become a well-rounded person. For your commercial benefit, people want to engage with people who are well-rounded people. And it's good for you, not just personally to the kid that you're advising, but commercially, and you want to be the kind of person that other people want to transact with, want to deal with. And so just making yourself a total geek for your whole life and thinking that these other things aren't important. Yes, I think people should read Shakespeare and learn history in college. And then you can come to Goldman Sachs and we'll, for 22 hours a day, we'll teach you your field.
Right, exactly. Only 22.
Yeah.
Okay, I think we have time for maybe one more question. Yes, Reg.
Thank you. Hi, thank you both for being with us today. Regina Cross with Goldman Sachs. I am also a former emerging leader with the council. My question is around leadership, and you've talked about your leadership, as a partner, pre-partner, and even across different economic eras. How has leadership changed today, and what are the skill sets that emerging leaders might need that perhaps they didn't in a different time period?
Once again, they're not the same, but they rhyme. It's pretty consistent. I'll say, something else. Goldman Sachs went public in 1999. But we were a private partnership for a long time, and again, half my tenure was rooted in one and then the other. I think it's really taken Goldman Sachs about 25 years to go public.
Right.
And well, because in order to maintain the partnership culture, it could have been done in an instant, but we would have lost a lot. Yep. But Hank ran the firm as a public company when we went public, but the insiders own most of the stock, and the board of directors, the board of directors was dominated by Goldman Sachs people. And over time, we became more and more owned by the public shareholders. And guess what? You run that differently. So in a private partnership, you care about your capital account, you care about your earnings, your E. In a public company, you care about your earnings, but you care about your PE. Right. Public shareholders want consistency. Private partnerships don't care over the life of your career whether you make the money in a smooth, accreting 5% incremental line. You can make it all in 3 years out of 10 as long as it gets made. And so over time, the balance sheet shifted. There's less investing on balance sheet, more investing in funds, more stable earnings, less. I think it took a long time. Could have been done more quickly, but the firm wouldn't have been. I think one of the great challenges and the leadership challenges for the last period was to keep a partnership ownership sense about the whole firm, and which means certain kind of inhibition, limitations on what leaders can do. And get yourself to be something that was much more desirable in the context of public ownership while maintaining the private partnership ownership kind of a culture. And I think that and as I look back, I didn't think about this at every stage, but if I look back and see how different the firm looks today and how leadership performs, very much acts like a private partnership. If you looked at the footings and you looked at the balance sheet, very much like a public company.
Yeah. Lloyd, terrific hour. I think Lloyd's available to sign books, take extra questions. Last one thing. Talk to me about when you knew you were funny and how you have used wit. Because I remember a story that you told, which maybe is completely inaccurate, but you said something very funny that as a smaller person in your high school, there were the only way to kind of make sure you weren't going to get beat up was either run really fast or be really funny, and you realized you couldn't run very fast.
Yeah, I eventually got the idea. I went to a failed high school, New York City, East New York, Brooklyn. I grew up in the projects. Right. The way I finally saved myself was I stopped going to high school and just took the exams and moved on and finished quick. I always had I don't know. I always had a perspective and kind of maybe an eccentric way of looking at, and framing things. I don't know. That's just, as Popeye said, I am what I am, boop, boop.
We'll leave it at that. Thank you, Lloyd.